Most founders think venture capital is about great ideas. Investors know it's actually about risk, scalability, and asymmetric returns. And that misunderstanding costs startups millions in lost opportunities. Every year, thousands of startups pitch venture capital firms believing, if our idea is strong enough, funding will follow. But the truth is far more complex, because venture capital firms are not investing in ideas. They're investing in probability. Probability of massive growth, probability of market dominance, probability of turning $5 million into $500 million. And when founders don't understand how venture capital firms actually make decisions, they unknowingly pitch the wrong narrative, emphasize the wrong metrics, overlook the risks investors see immediately, which means deals quietly die in partner meetings founders never attend. Today, we're breaking down how venture capital firms truly evaluate startups, not from the outside, but from inside the investor mindset. At its core, venture capital is a high-risk, high-reward investment model designed to fund companies capable of extreme growth. Venture capital firms raise money from institutional investors like pension funds, university endowments, sovereign wealth funds, family offices. These investors are known as limited partners, or LPs. The venture capital firm itself becomes the general partner responsible for investing the capital. Their job is simple in theory, but brutally difficult in practice. They must find a small number of startups capable of returning the entire fund multiple times over, because most startups fail. In a typical VC portfolio, 50–60% fail completely, 30–40% return modest capital, 10% generate meaningful returns. 1–2 companies become massive winners. That means venture capital firms are not looking for good companies. They're looking for extraordinary outcomes, which is why venture capital typically sits within a very specific part of the startup lifecycle: late seed stage, Series A, Series B, early growth stage. Before this stage, startups often rely on bootstrapping, angel investors, incubators, accelerators. Once venture capital enters the picture, the expectation shifts dramatically. Now the goal becomes rapid, scalable growth. Understanding how venture capital firms think can fundamentally change a startup's trajectory. Because venture capital is not just about raising money. It directly affects valuation, ownership dilution, strategic direction, governance structures, long-term exit potential. If founders misunderstand how investors make decisions, several things can happen. They may pursue venture funding when their business model isn't suited for it. They may accept investors who push the company toward growth strategies that create risk. Or worse, they may burn months pitching investors who were never going to invest in the first place. But when founders truly understand investor decision frameworks, everything changes. They learn how to structure their narrative, present the right metrics, address risks proactively, build investor confidence, and that dramatically increases their chances of securing capital. When venture capital firms evaluate startups, they are rarely asking the same questions founders expect. Most founders focus on their product, their technology, their passion. Investors look at something very different. They analyze 5 critical dimensions. 1. Market size. Venture capital firms are fundamentally market investors. Even a brilliant company cannot produce venture-scale returns if the market is too small. Investors ask, is this a billion-dollar market opportunity, or is it a niche? 2. Founder capability. Investors often say, we invest in founders, not ideas, because markets evolve, products change, competition emerges. The founders must demonstrate adaptability, strategic thinking, resilience, leadership under pressure. Scalability. VCs look for business models that scale exponentially. Software platforms, marketplaces, network effects, global distribution. Businesses that require heavy physical infrastructure often struggle in venture capital environments. 4. Defensibility. Investors analyze whether competitors can easily copy the product. They look for network effects, proprietary technology, data advantages, brand dominance. Without defensibility, growth can quickly disappear. Exit potential. Ultimately, venture capital firms must generate returns for their investors, which means they evaluate potential exits, acquisitions, strategic buyouts, public offerings. If the exit pathway is unclear, the investment becomes far less attractive. Many founders approach venture capital with several common misconceptions. Myth number 1, the best product wins. Investors do care about product quality, but they care more about market opportunity and execution capability. A strong team in a massive market often beats a perfect product in a small market. Myth number 2, traction is everything. Traction matters, but investors also examine the nature of the traction. Is it sustainable? Is it scalable? Or is it artificially boosted by marketing spend? Myth number 3, funding equals success. Raising venture capital is not the finish line, it's the starting gun. Once funding arrives, expectations increase dramatically. Growth must accelerate, milestones must be met, and investor oversight becomes part of the company's governance structure. Myth number 4, investors decide alone. In reality, venture capital decisions are rarely made by one person. Most firms require partner meetings, internal debates, investment committee approvals. A partner may love your startup, but if the rest of the partnership disagrees, the deal often dies quietly. So how should founders approach venture capital strategically? At MP Nerds, we often recommend evaluating startups across 4 structured dimensions. Step 1, idea validation. Before approaching investors, founders should validate: is the problem real? Is the solution compelling? Is the market large enough? Weak problem validation is one of the fastest ways to lose investor confidence. Step 2, feasibility analysis. Founders must understand technical feasibility, operational complexity, regulatory risks, cost structures. Investors quickly detect when founders underestimate execution challenges. Step 3, strategic road mapping. Investors want to see a clear growth trajectory. This includes MVP launch, early traction milestones, scaling strategy, expansion phases. A structured roadmap signals strategic maturity. Step 4, risk mapping. Professional founders proactively identify risks such as customer acquisition challenges, competition, regulatory hurdles, technical dependencies. Addressing risks early builds credibility with investors. Consider 2 startups entering the same industry. Startup A. Startup A focuses heavily on its product. Their pitch emphasizes features and innovation. But when investors ask about market size, customer acquisition strategy, defensibility, the answers remain vague. The deal stalls. Startup B. Startup B approaches the process strategically. They present a clear market analysis, structured growth projections, risk mitigation plans, a realistic scaling roadmap. Investors immediately see professional execution thinking. Startup B secures funding within months. The difference wasn't the idea, it was strategic preparation. Here's a deeper insight many founders miss. Venture capital firms are not only evaluating your company, they are evaluating your future decisions. Investors ask themselves, if this founder receives $10 million, will they allocate it strategically? Will they hire effectively? Will they adapt if the market changes? Or will they burn through capital chasing growth without discipline? This is why governance structures often emerge after investment. Board seats, investor reporting, strategic oversight, because venture capital is not just capital, it's a partnership in decision-making. Let's bring everything together. Venture capital is not about ideas, it's about probability and scale. Investors evaluate market opportunity, founder capability, scalability, defensibility, exit potential. Founders often misunderstand these priorities, but those who align their strategy with investor thinking dramatically improve their chances of success. The difference between a rejected pitch and a funded company often lies in how the business is structured and presented. At MP Nerds, we don't just build MVPs. We help founders structure businesses to be investor-ready. That includes idea validation and feasibility analysis, strategic road mapping, risk assessment, market positioning, scalable MVP structuring. Because turning an idea into a real company isn't just about building a product, it's about building a strategy investors believe in. If you found this breakdown useful, let us know in the comments. What startup topic should we cover next? And if you're building something ambitious, consider subscribing for more insights into startup strategy, venture capital thinking, and building companies that scale. We'll see you in the next episode.